Welcome back to another explainer. Even if you follow business incredibly closely, the actual mechanics of a balance sheet or a financial ledger can sometimes feel, well, like an impenetrable wall of numbers. But today we're going to completely demystify the language of business. We are diving right into the bedrock principles, the absolute grammar, really, that govern every single financial move a company makes. So let's get into it.
Okay, let's dive into this. Have you ever wondered what exactly is going on behind the scenes when a business makes a sale, pays rent, or, buys a new computer? It isn't just a random pile of receipts sitting in a shoebox. In any business activity, there's a constant give and take going on, which we call a transaction. And to really understand the health of a business, every single exchange of money, goods, or services absolutely must be recorded in a highly scientific, orderly way. Here's our roadmap for today. First, we'll look at the language of business. Then, we'll break down the rule of three: personal accounts, real accounts, and nominal accounts. Finally, we'll see these golden rules applied in action and briefly touch on the modern approach.
Section 1. The language of business. Before we learn the grammar, we really need to understand the language itself. Basically, we're translating the chaotic, fast-paced actions of the real world into perfect order. That translation process, it's called bookkeeping. Bookkeeping is just the fundamental activity of recording financial data relating to a business's operations, that give and take we just talked about, in an orderly manner. It is the absolute crucial recording phase that all further accounting relies on. And honestly, what's amazing is that this double entry system, which recognizes the twofold aspect of every single business transaction, was actually first evolved by Luca Pacioli. He was a Franciscan monk from Italy. This flow perfectly illustrates the chronological life of a financial event. Think of it like a journey. Everything starts out in the wild as a real-world transaction. From there, it gets recorded chronologically into a book known as the journal. Then, periodically, those journal entries are transferred or posted into their specific dedicated accounts in the ledger. This cycle right here is literally the heartbeat of business. But how do we know exactly where to put things in the ledger? Well, that brings us to our characters. Section 2. Personal accounts, the who. Meet the first of the three fundamental characters in our business grammar. Personal accounts deal with the specific individuals, firms, or entities that the business actually interacts with. And here is your very first golden rule of accounting. You might want to commit this to memory because it functions basically like an absolute law of physics in the business world. Ready? Debit the receiver, credit the giver. I'll say it again. Debit the receiver, credit the giver. If a person receives a benefit from your business, you debit their account. If they give a benefit to your business, you credit them. It is that beautifully simple. But wait a second, who actually counts as a person? Accounting is wonderfully broad here. Personal accounts are split into categories. On one hand, we have natural persons, which our source affectionately notes as the creation of God. This just means real, breathing human beings, like Ramesh or Suresh. But on the other hand, we also have artificial persons. These are corporate bodies or institutions that are legally recognized as persons in business dealings, like Tata Limited or CSJMU. The cool thing is, whether you're dealing with your neighbor Suresh or a massive corporate entity, the golden rule applies exactly the same way. Section 3. Real accounts, the what. Now we're moving smoothly from the who to the what. Our second character in the grammar of business is the real account. This category captures the assets, the actual things that the enterprise owns and utilizes to make money. So the crucial point is our second golden rule. Debit what comes in, credit what goes out. The rhythm here is super straightforward. If your business acquires an asset, it comes in, so you debit it. If an asset leaves your business, it goes out, right? So you credit it. In and out. Now, you might be thinking what comes in is always something physical. Well, not exactly. Sure, we have tangible real accounts, things you can physically touch and feel, like a plot of land, machinery, or a stack of cash. But we also have intangible real accounts. These are assets that don't have a physical shape at all, but they hold immense value that's measured in money. We're talking about things like patents, trademarks, or business goodwill. In the eyes of accounting, an invisible asset like a patent is tracked using the exact same rule as a physical pile of cash. How cool is that? Section 4. Nominal accounts, the why. Finally, we arrive at the third character in our triad. Now, unlike people or physical assets, these accounts don't physically exist anywhere. They are opened purely to explain the nature and the reasons behind our business transactions, the why. And here's our third and final golden rule. Debit all expenses or losses, credit all income and gains. Let's just say that one more time so it really sticks in your mind. Debit the expenses and losses, credit the income and gains.
Let's ground this abstraction in some everyday business realities. If you pay rent for your office or pay salaries to your employees, those are expenses. They get debited. Easy. Even if something unfortunate happens, like the example from our source where goods are stolen by the storekeeper, that creates a loss account. And yep, that loss is also debited. On the flip side of the coin, if you earn interest on an investment or receive a commission, those are your incomes and gains, and they are always credited. Section 5. The golden rules applied. Okay, now what's really interesting about this part is seeing it all in action. We have the who, the what, and the why. Let's trace a concrete example straight from our source. Imagine a Mr. A commences his business with $70,000 in cash. What actually happens in the books? Two accounts are involved here, cash and capital. Cash is a real account. According to our rule, cash is coming into the business, so we debit what comes in. Capital represents the owner, which is a personal account giving to the business, so we credit the giver. Or consider paying $500 in wages. Wages are an expense. Remember, that's a nominal account, so we debit all expenses. We pay those wages with cash, a real account going out, so we credit what goes out. By rigorously applying these 3 golden rules, every single business event falls into perfect, balanced harmony. It's like a giant puzzle where every single piece fits. Section 6. The modern approach. Now, while those 3 classical British rules form a perfect logical foundation, there is a modern American approach that simplifies this whole thing into a mathematical equation. Instead of rules based on the nature of the entity, everything is divided into exactly 5 categories: assets, liabilities, capital, revenue, and expenses. This basically acts as a modern cheat sheet. In this system, if an asset or an expense increases, you debit it. If a liability, capital, or revenue increases, you credit it. It's a slightly different angle, for sure, but it achieves the exact same perfectly balanced books as the traditional rules we just learned. So, whether you use the timeless golden rules of Pacioli or the modern equation, every single transaction is now scientifically recorded, categorized, and balanced. But, that leaves us with a pretty fascinating cliffhanger. Once the journal is full and the ledgers are perfectly balanced, what happens next? What story do all those numbers tell when we compile them into the trading account, the profit and loss account, and the ultimate balance sheet? Does the business survive, thrive, or fail completely? Well, that is the magic of final accounts, and definitely a topic for our next deep dive. Keep learning, stay focused, and I'll catch you in the next explainer.